Hello, my name is Seamus Moran. I'm an accountant in development. I'm the domain expert. And I'm going to talk about what we've done for topic 606 and IFRS 15, revenue from contracts with customers. I'll talk a little bit about the requirements, then I'll go on to the product, Fusion Revenue Management. I'll talk about the transition arrangements. I'll quickly mention what PeopleSoft and JD Edwards have done. Fusion Revenue Management addresses EBS. And then I'll show you where we are on the timeline. The new revenue standard became US GAAP and IFRS on May 28, 2014. I'm speaking on October 28, which is exactly 5 months afterwards. It was published as topic 606 for the Americans and IFRS 15 for everybody else. The text is pretty identical. There are some minor differences that tie into the lexicon that the IAS and the FASB use. The implementation timeline for all companies, whether here or abroad, is around January the 1st, 2017. There are some considerations. Some people can go 2018, some people can go 2016, but in general it's if your year end is after the 15th of December 2016, that's the year end you take up this standard. There are two options on retroactive reporting and I'll drill into those. Here's where we are on the calendar. We're in October. This slide deck was made for OpenWorld, so October 9th is where the arrow points to. And we've got only so many months to go before we get done. So we are in a hurry, but don't panic, we'll be all right. It applies to all companies in all industries in all countries, except for insurance and leases. It applies to US GAAP and it applies to IFRS. And it cancels everything you know already. It repeals all the existing guidance. They no longer apply. There's a long list on the slide of US GAAP elements that are cancelled, and IAS 11 and 18 are cancelled. Safe harbor statement. We're talking about futureware a little bit, and I don't want to promise anything more than I should, so I won't. Our commitment to deliver any material or functionality is based on our success in building the product and on our own wishes as Oracle. The product exists. It's out there already. What happened was we were ready to publish it at OpenWorld 2013. We were all ready to go and announce it. But the standard, which was slated to come out also at that time, did not come out. In fact, the boards took it and wanted to exercise a genuine close, so they got 6 big companies to voluntarily allow them to watch the close and recalculate that close as if it were under the new rules at the end of 2013. So the standard didn't come out until May 2014. So what were we to do with our new product we were ready to announce? Well, we put a US GAAP face on it and we released it for US GAAP and existing high-tech and we tested it in the field. So we're very confident that the architecture works, that the product is a solid product. So here are the principles of the standard as we built to and as really everyone should think to. This is a slide from the IASB and the FASB that says you must recognize revenue to depict the transfer of goods or services to customers. That's the core principle. You must recognize as you perform. You must not recognize after you've performed. You must not recognize before you performed, but as you performed. And you must value the revenue in the amount that you expect to be entitled to for that deal, for that transaction. So the amount you expect to be entitled to is a little bit different from fair value if you're used to fair value. It's a little bit different to everything we've done before. So we'll come back to that. And then they go and they specify not once, not twice, but 3 times in the standard how you should apply this principle, how you should value the obligations you have to perform on behalf of your customers. First, you must identify the contract with the customer. And that might mean adding contracts together. And it might mean adding things together that are stored in different products, such as project accounting or order management, or a product that is not an Oracle product that you're using in a front office. Once you've identified the contract, then you must identify the separate performance obligations. Performance obligations are what you have promised to a customer, and they're at the level that you expect to bill them. So they're the equivalent of unit of account, if you like, in the old American GAAP. They're a little bit different. But if you concentrate on what you've promised your customers and how you expect to bill them, you'll get them right. Once you've identified those two, you'll determine the transaction price. for revenue purposes. What's the total price on this deal? So you add up the lines, and then you ask yourself, are you going to get it all? And if you're going to get it all, the total price is it. But if you're not going to get it all, you have to think about a constraint they have, where they say don't recognize revenue at more than the right value. When you've identified the total price, and you must then allocate the transaction price. So what this means is you must look at your standalone selling prices. You must observe your standalone selling prices. You must take in your estimated selling prices and apply them to the performance obligations, so you come up with a total that might or might not be different to the selling price total. If it's different, then what you do is you allocate those prices using the percentage of the total you've just arrived over the transaction price total. I'll go into that in a minute and show you what we mean. So that's allocate the transaction price, and then you recognize your revenue at the performance price you've just calculated. The reason you go through the 4 steps in the chevron is to come up with the performance value of each performance obligation rather than the invoice price. What's going on is that they're replacing the concept of deferred revenue with the concept of performance obligation accounting. Deferred revenue takes a sales invoice, deals with the carve-in and carve-outs and the releases to the income statement, and the balance is a sale that you're going to post to the P&L in a future month. Performance obligation accounting looks more precisely at what you owe the customer and says, when do you think you're going to deliver the customer? And it doesn't schedule revenue as much as it waits for you to perform on that performance. So there's a difference. In one, you're valuing a sale minus reasons for it to be different. In the other, you're valuing something specific that you owe your customer and you owe it to them at your prices. So in detail, when you bring that down to the system level, in the old days you billed and then you deferred. Now you follow the 4 steps to valuation. In the old days, you didn't recognize revenue if you didn't have a fixed or determinate price, or if you had updates that you were going to deliver later. Now you must recognize the revenue on what you have performed when you have performed it. In the old days, you had fair value that was made up of your VSOE, your third-party evidence price, and maybe your estimates and residuals. Tomorrow, your performance obligation value is your observed selling price, still the same, your ESP, and no residuals unless you've got 1 or 2 situations. At a system level, in the old days, revenue and deferred revenue were valued at invoice value plus or minus carve-ins and carve-outs minus releases. In the new days, performance obligations are valued at performance obligations per step 4. That's a big difference. Many of the other things are the same. You won't follow the carve-out anymore, though. You'll follow customer satisfaction. It's not limited to American high-tech companies. It's applied to all companies. In essence, they've taken the hard rules that apply to the complex rules that apply to American high-tech companies and simplified them, and they've taken the absence of rules on many other companies and added the rules. So we've moved towards the middle. So this is what we set out to do with the product. We set out to follow the chevrons. 1, we'd identify the contracts from multiple sources, and 2, we'd identify the performance obligations in there. 3, we'd calculate the transaction price, and 4, we'd allocate that to the obligations using established SSPs and ESPs and relative allocation. Then 5, we'd recognize the revenue of performance, we'd book it to obligation liabilities or obligation assets, and when you transferred, we would recognize revenue. And finally, we'd give you accounting, SLA entries into your general ledger, and we'd give you a report so that you could analyze what was going on. So we set out to map precisely to the 4 chevrons and the box. And then this is how we built it. We built it in a simple manner that's straightforward. We would take in data from all sorts of areas. On the left-hand side of the screen, you'll see OM, which is order management, AR, PA. Down the bottom, you'll see custom, Excel, and non-Oracle. We were very aware from the get-go that we'd be importing from different places. Then our engine goes through the 5 steps. We identify the contracts. We link different lines together from different products according to business rules you have. We identify the performance obligations. You can assemble deliverables into a performance obligation and performance obligations into contracts. We value the contract in total, and then we value it, the performance obligations, using SSP and ESP. And then we record it, and then we give output. So that's what the plan was. This slide talks about how you operationalize it, what's actually going on. This is probably the second most important slide in the deck. The table at the bottom is a notional table. It's an Excel table built by myself, and the details don't matter much. It's the boxes that matter. So I start by identifying the contract. I've imported lots and lots of data from project accounting, from order management, from non-Oracle products, from Excel. I've brought in lots of it. I've used my simple rules. Is it signed by the same sales guy? Is it signed within a week of each other? Are they between your subs and my subs? How related are they? And I've identified that the first 3 lines are one contract, even though one's in projects, one's in OM, and the other is an alien import. And the second 3 lines are also in one contract. And I've given each of these contracts a number, 1,000, 1,100, 1,200. So I've identified the contract, step 1. Within that, I've looked at the deliverables and I've seen whether or not they're performance obligations. So in the first one, the first 2 deliverables are actually the same performance obligation. The classic example is a tractor and a trailer on an 18-wheeler. So this customer wants the 18-wheeler. He doesn't want the tractor and the trailer separately. The third line is maybe the maintenance on that rig, and so on. So I've identified all 3 lines are separate performance obligations in the second contract, and the 2 lines in the last contract are also separate obligations. So we've identified the performance obligations. Next, we identify the transaction price. So I look at the amount to be billed and I foot it. I add it up. And if the total is reasonable, that will be the answer. If you've got some restriction on it, if you've got variable, it won't be as simple as adding up. I've done this for illustration. And then in the last box, in the orange box, I've allocated my SSPs and my ESPs to that deal. You'll notice that the total is the same. On the first contract, the total is 6,000 on the billing box, and it's also 6,000 in the performance obligation box. So I've now done my revenue allocation. I've got my performance obligations, and it has happened before I've done anything. I haven't shipped, I haven't billed, and all of that is logical. That's not process, it's logical valuation. So now I'm going to do my accounting. My accounting flies in from the right. And here, what I want to draw your attention to are the oval circles. I'm doing the bookkeeping from the performance obligation valuations because we're doing performance obligation accounting under the new standard. I'm not doing my bookkeeping from the blue box of invoice values. So I'm not taking invoices plus and minus carve-outs. I'm taking performance obligations minus invoice equals applied or unapplied discount to another line. So that's the new bookkeeping. Don't worry too much about the detail of the bookkeeping. The sequence will produce different results if I ship before I bill, if I bill before I ship, if I ship the second one before the first, and so on. It's really quite interesting what the combinations are. But that's the key difference here. We're doing performance obligation accounting under the new standard. We did deferred revenue accounting under the old, and they are not the same thing, and they can result in differences for 5 different reasons. Because the prices are different, because the performance obligations are different, because the revenue recognition is different, and then within that, because the allocation has a different basis, and because the performance obligations are not merely different, but they might be different at a distinct level, at the unit of account level. So all of that's quite interesting. That's the bookkeeping. That's what we're shooting to deliver in the new product. So let me tell you about the product, Fusion Revenue Management, and what its footprint is and what it does. This is the actual most important slide in the deck. This actually shows how Fusion Revenue Management works, gives you its footprint, and shows you how it ties in with EBS. Up the top, across the top, and across the bottom, you will see modules in EBS. EBS Order Management, EBS Service Contracts, EBS Projects, etc. Over on the right-hand side, you will see third party. Again, we were very careful to include third party. Along the bottom, you'll see that we're writing back and reading from EBS Order Management, EBS Accounts Receivable, EBS Costing for the matching, and General Ledger. EBS GL and EBS SLA is what that means. On the cloud, and I hope you can see the cloud on the slide, sometimes it's difficult to see, but on the cloud you've got Fusion Revenue Management, and in the first box, it's doing the 4 chevrons, identifying the performance obligation and valuing it from many sources. identifying and valuing the contracts from many sources, establishing the selling price and the ESP. And it's doing that in a VSOE engine that's very thorough. So we're doing the 4 steps in the first box. In the second box, we're recognizing the revenue. Following the contract ID, we will use the contract ID to track revenue. We will associate its billing with it. We will associate the performance obligations with it. We do all that in Oracle's relational database, which is very easy to do for us. We will value at the performance obligation, and then we will count satisfaction in many different ways. Ratable, immediate, pending, getting the text from the UPS driver, all of those different ways. Whatever you've got, we will pick up the satisfaction from there, and it might be through inventory that you've shipped or whatever. Then we'll create the accounting. We create the accounting, and we will book it to revenue, to contract liabilities, and to contract assets. We will use a clearing account with the receivable, and we will keep the clearing account clear. And then we will post it all to general ledger using SLA. And finally, we will give you lots of reports, both to reconcile billing to AR, billing to receivable to revenue, and then performance obligations to revenue, billing to performance obligation, etc., etc. Tons of reports and tons of ad hoc reports. You can run it on premise. We run it on cloud. We expect that you won't run it on premise in general because you won't want to set up the Fusion stack. But if you set up the Fusion stack for other reasons, fine, it runs on premise. The key thing here is that what I'm telling you is it's fully integrated with EBS. It's fully integratable with any ERP. All of those are revenue events that are extracted from delivered source views. It's a service that will read input, and it will read input from any ERP. So you can get an SI to make it read from SAP if you wanted. It is a full Fusion product with all of the Fusion benefits, the work areas, the automated compliance, the social, the SAS, and so on. It's modern software in a modern environment. I'm not going to discuss Fusion and its advantages here, but they are all available in this product. The integration with EBS is the latest science on integration at its peak. It's Oracle to Oracle, and it's very good integration. It's very good at reading the data and writing back. So integration between cloud and non-cloud has become quite a science here at Oracle, and this maximizes it. Now, the other thing I want to say, I've explained how it satisfies the standard, and I've explained a little bit. I'm an accountant, I'm not a technical guy. I've explained a little bit how it's integrated, but it's also very useful and convenient for the revenue managers, for the revenue accountants who work with it. The identification of the contracts is automatic. There should be no need for manual interference except at the point of judgment where you want to say, well, no, that wasn't the contract that's related. You know, we sold EBS and Hyperion and Fusion Revenue Management to a credit card company, and all 3 were signed on the same day in New York. And by coincidence, on the same day in Brazil, we also signed a deal with the Brazilian subsidiary of that company. Well, they might be related contracts or they might not. You can decide that. And then we manage the pricing also in a way that's very easy for you to automate it to the max and then review the judgment points. And we do the allocation. It's fully automatic. It really doesn't need any hands-on unless you wish to interfere. We track the performance obligation, so you know your performance obligation is either an open order and not booked, or it's a liability, or it might even be an asset if you haven't billed it yet. And you know when you've billed it and when you've shipped it. We track it quite clearly. We track performance obligations under the contracts, so you'll see which performance obligations are in which contracts, and you'll see which performance obligations were billed by which invoices. We can adjust everything and manage revenue. Adjusting everything is talking about when the sales price changes, either at the transaction level or on the SSP level. We can do the appropriate adjustments, and we manage revenue. That's having a look at your performance obligation and asking, why hasn't that one been recognized yet? Let's get Billy out there and drive the recognition of it. So now I'm going to talk a little bit about what happens between now and 2017, January 1st, 2017. You have 2 options to get to the standard, in the standard. These are spelled out by the standard. Up front, I'll say that most accounting standards, and as an accountant, I was manager of external reporting at a New York Stock Exchange company here in Silicon Valley before I joined Oracle. And we took up several standards back in the day. They're all prospective. What that means is you don't change your opening balance sheet most times. In fact, I've never seen one where you do change your opening balance. But on this, you do, which means they're retrospective. That's what retrospective means. You have to revise your closing balance sheet to start the new year under the new rules. They give you two options to do that. You can do it either so that you restate your previous year's financial statements or so that you do disclosure in your future years. Either way, you have to change the opening balance from being the deferred revenue balance to being the performance obligation balance. One of the companies that looked at this when the boards looked at the 2013 December close, one of the companies had deferred revenue of $4 million in respect of a software game they had published where certain, episodes of the game were missing. It needed to have 18 episodes, only 12 are ready. They shipped it with the 12, they sold it to a big box store, and they got $4 million, so they got all their money in. So they had their money, they made the sale. But under the old rules, they couldn't recognize any of the $4 million until they had completed shipping the extra episodes. So that means under the old rules, they had $4 million in deferred revenue. Under the new rules, they had already performed $3 million of it by shipping it and selling it, and the other $1 million was the only amount that would remain under the performance obligation rules. So they had $1 million they would perform after uptaking the new rules, and that meant that the $3 million out of the $4 million went down the drain and went into a black hole. Sure, they could tell the investors through either restating their income statements or through later disclosure, but it wasn't on the face of the income statement. That is a big deal. So that's option one. Option two means you reprocess everything through 2020 using your old software. That's actually what the Big Four are suggesting might be the favorite. I think of it as a little bit of a nightmare because you're going to be running your existing software all the way to 2020 while running new software in the interim. Either way, you've got to model it. You've got to model it both to figure out the dollar amount, to decide what model you're going to use after the new standard comes into play, and to do your disclosures. So I'm thinking even if you think you've made your mind up, you're still going to be modeling it so that you can validate having made your mind up. To do that, you need to be able to reprocess 2015's transactions, 2016's transaction, and we've designed FRM so that you can reprocess them. I guess I just said this on the last slide. You need to model them, and we're suggesting that you do that. Use your revenue recognition, the existing RevRec to do the old rules. Use FRM to redo and to iterate, and use Essbase or Excel. I'm saying Essbase because I work at Oracle and it's a great product, but you know, if you can't afford it, Excel will do, to figure the difference. And this is what that might look like. Complicated looking chart. If I start with the box that says homegrown, that's what you're doing today. You're using revenue, you're using AR and a homegrown product to come up with revenue. The little picture has Dilbert and his admin bringing in enhancement requests, and he has no intention of doing them. That's kind of what's happening. And that's what's going to happen to old revenue calculations and software. So you send the output from that to General Ledger, and from General Ledger you send it to EPM, and you come up with your original financial statements for 2014 and 2015. And in 2016 or 2017, you will come up with your revised financial statements from the same data. Along the lower line, we follow topic 606. We follow our product doing iterative modeling of your transactions. We'll be ready in the middle of 2015. You get it up by the end of 2015. In 2016, you look at 2015, 2016, you redo those, you compare and contrast, you come up with what you intend to do, you come up with your disclosure numbers, you come up with the dollar impact, and you come up with the data you need to do your financial statements, to revise your financial statements. And then just before your cutover date, just before your final balance sheet, you turn this on to come up with the balance sheet and to be your subledger in the future and to produce your ongoing financial statements. The benefits of doing this is that you can actually figure the monetary impact, the dollar impact. You can actually figure your model to quite some detail. You can look at different pricing, different performance obligation definitions. You can look at different RevRec rules. When do you think you perform? And you can see what happens. You can identify and value the alternative choices in all of that, and you can track the data that you need to do the external reporting. The picture looks like this if you decide to use option 2, which is to do a big bang on the take-up date and then to compare and contrast afterwards. You've got the same modeling to do in advance, and then you carry forward the analysis, the S-base cube or the spreadsheets to compare and contrast afterwards for your disclosure. So now I'll talk a little bit about PeopleSoft and JD Edwards. Both PeopleSoft and JD Edwards have a contract model that manages their receivable, and they're amending that contract model so that you can group contract and identify performance obligations and then revalue them at the revenue prices. They're doing that inside their contract module. Now the expectation is in both products, in JD Edwards they've done it in 2 places. The expectation is that that will satisfy most of their customers. If their customers are not satisfied with that, then FRM on top of PeopleSoft is a great solution. So we're covering all bases there. Now here's where we are with FRM on the timeline. I put this slide up before. It shows the differences between the old and the new. And I don't want to go through it again or anything. What I want to say is that today, 5 months to the day after the standard came out, the people who have jumped into the new swamp are the IASB and the FASB. But there's a bulldozer coming behind us, January 1st, 2017, that's going to push us all, like lemmings, over the edge. So the advisors are getting there now. You're beginning to see more and more detailed advice and counseling from the Big Four. Right behind them are the software people like myself. I like to think that we're actually a little bit ahead of everybody else. So when you're concerned about the dates I'm showing you, I think we're moving pretty fast, believe it or not. And then behind that are the public companies and their management and external reporting teams. And the key thing is that when we're done, all the old rules are gone away. You've only got the new rules and the new language to deal with. So we've released the product already, as I mentioned earlier. We released it in March on, I forget what release it was. It was on 8 and now it's on 9. 9 came up in October, the month just finishing. What we did was we replaced contract with customer with multiple elements for the Americans. We replaced performance obligation with the elements of an arrangement. We replaced observed and estimated standalone prices with VSOE, with third-party evidence price, which is illegal now, and with ESPs and residuals. We replaced contract liability with deferred revenue. And you can see that product working if you're interested under the old rules, and you can see that today. You can have a demo of it, and if you have a customer that wants to do old rules, then it's the perfect job for them. And that's the same position that our competitors are in, such as RevPro and RevStream and so on. What we're doing to change it is we're bringing it back to be contract to customers and performance obligations and observed prices and contract liabilities and assets. So that's the first thing. We're taking off the lipstick we put on before. And then we're building transition arrangements. We have to make it so that you can reprocess transactions. Right now we control it so that you can't reprocess transactions because you don't want to book anything twice. It's an internal control. So we're putting a switch on that. We'll make it so we're going to do performance obligation accounting. We're going to do the right rules. We're going to do whatever we hear from the customers and the Big Four. And again, so far at the 28th of October, we haven't heard much from customers in the Big Four about what they'd like us to do rather than what we're proposing. We'd like to hear from you on that. And the issue here is that our thinking is no faster but no slower than your thinking. So while you're working out what you're going to do to it, we're working out what we're going to do to it, and we're at the same speed. So you can't give it to us ahead of, you know what I mean. So here's what the timeline looks like in terms of management and so on. In March 14, the standard, our product came out. In May 28, they finalized it. Since then, we've been looking at it and studying it. We have begun wholeheartedly and are deep into code. We're talking to customers in the Big Four along that bottom line, and we'll be coming out with the release in the middle of next year. That release will be It's difficult to say what number it will be on because we'll be catching the release train, if you like. But whatever's coming out in the middle of the year, we'll be on it. So that's our expectation. And that's where we are. Now, customers in Big Four are giving us input, are beginning to give us input now. And so we're listening very careful to you. And what you hear will come out in releases that are after the one that comes in June. So here are the specifics of where we are and where we'll be in the summer of 2015. Today we identified the multiple element arrangement. Tomorrow it'll be the contracts with customers, mostly semantic, a little bit of hardwiring to fix. Today we identified the element. Tomorrow we'll identify the performance obligation. Today we value the MEA. Tomorrow we'll value the contract. Today we value the element in the VSOE. Tomorrow we'll value the performance obligations. And we'll use SSP and ESP. Today we've got the 5 steps. That's perfect. We're leaving it alone. Today we account for deferred revenue, which are sales invoices. And tomorrow we'll account for performance obligations. And we'll also do the valuation before we invoice. So we'll do the valuation orthogonally to invoicing. It's not really a sequence thing. It's a valuation thing. Today we've EBS and instance integration. That will continue. Today we do high-tech VSOE delivery, and we're going to make that a little bit more general, a little bit more welcoming to other industries. And then after our summer release, later on, the input we get from you will get incorporated at that point. We'll also have more features, enhanced features, and we'll do other features in other products. And finally, we'll do the disclosure a little closer to the time when the disclosure is needed, and people have been talking about it, ready for use in 2017. And so to clean up, to finalize, this is where we're at. Don't panic, do hurry up, get your head around it. Review your quote to revenue cycle. Identify what you've got, get your patterns right, get your data right, know what you're doing. Identify your process gaps. You're not thinking in terms of performance obligations now, you're thinking in terms of revenue schedules. You have to switch that thinking. Model the impact on your P&L. When are you going to take your deferred revenue on cutover date? Are you going to take that deferred revenue in the future or not? And much of it you may not, especially if you've got to defer a lot of revenue. So look very carefully at that. Get onto release 12. FRM works seamlessly with release 12. And then we have a blog where you can see updates. Although right now I'm so busy I haven't posted any updates in a few weeks, not since OpenWorld. Thank you very much. And please send questions. I'm delighted to get them and to answer them. And please contact us if you'd like to see this deck at management or if you'd like to see a demo.